why are you so motivated to continue to do this work? I'm highly motivated to help the people that I work with get to where they want to go. That provides me both of my parents were teachers. I really want to see those people succeed and accomplish their professional and personal goals. And that is highly motivational to me. And so continuing to get out of the day to day and into the things that's going to allow me to do that and do that well is what really keeps me highly motivated.
Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Welcome, everyone, to episode 35 of Offshoot. My guest today is Derek Myron, managing partner at Centura Wealth Advisors, a San Diego-based registered investment advisor specializing in ultra-high net worth families. Typically, folks with $20 million or more in assets and at least $2 million in annual income. Since founding Centura in 2014, Derek and his team have grown to 62 professionals, managing $1.4 billion in assets, with ambitious plans to quadruple that over the next 5 years. What's really interesting about Derek's approach is how he's evolved wealth management way beyond just picking stocks and bonds into a comprehensive tax planning and asset allocation platform. For clients paying, say, $900,000 in taxes on $2 million of income, Derek's team can find ways to cut that tax bill in half or more. They've extended their value proposition way beyond asset management to high-impact financial engineering. Derek's path here wasn't exactly conventional. He grew up north of Seattle, worked construction for his older brother, got unexpectedly fired by him, and ended up at Principal Financial Group just before his father died from a stroke at age 66. That loss, and watching his family get let down by their financial advisors, became the catalyst for his career. He got a CFP designation and committed himself to doing better for families than what he'd seen growing up. Warning, this podcast gets pretty technical pretty quickly. That's the nature of this domain. It's not about marginal tax rates. It's about how you calculate what's taxable. This isn't like a hand-waving wealth management discussion. It's pretty precise work with real economic impact. Listen in as we cover topics that include how index replication works, systematically harvesting losses that can add 0.5% or 2% annually while maintaining the same market exposure, why ultra-high net planning starts at $20 million in assets and $2 million in revenue, and how the sophistication of solutions scales dramatically at that level versus commodity asset managers working on smaller accounts. The leveraged long-short strategy that lets clients manufacture capital losses by borrowing on margin to take simultaneous long and short position, harvesting losses in both up and down markets while staying perfectly hedged. How tangible property regulations differ from cost segregation, potentially eliminating depreciation recapture by converting improvements from depreciation to a one-time expense, sometimes unlocking millions in immediate deductions. Why Centura targets a 5x return on total fees for its planning clients. If it's going to cost $200,000 in combined fees to implement their strategies, they want client savings of at least $1 million. How they exercise investment discretion through a CIO with 3 public and 3 private marketing professionals vetting everything before 6-person client-facing teams can allocate into any investment vehicle. Why Derek prioritizes employees over clients, believing that if the team isn't satisfied with their career, they won't stick around to serve clients well. how they think about the Goldilocks zone for firm size. Too small means losing access to alternatives and paying more for services. Too big means catering to the lowest common denominator and diluting your core service and value proposition. Their process to extract core values, where they identified top performers, unearthed adjectives describing those top performers, ranked everyone, including the executive team, against those values, and found new core values that define what success looks like at Centura. Why Derek believes you need to build your accountability chart without thinking about any current employees, then assess whether you have the GWC, which is get it, want it, have capacity for each role. And finally, his advice for entrepreneurs: stay humble, get good mentors, and find your tribe through CEO groups or peer networks that function like a mini board of directors. Derek's got a refreshing combination of technical depth and genuine humility. He's not out there claiming to be the smartest guy in the room. He's just relentlessly focused on solving the problems of ultra high net worth investors while building a firm that helps his team get where they want to go. There's a clarity to how he thinks about the business that I think any entrepreneur can learn from. I hope you enjoy this as much as I did. Derek, welcome to the podcast.
Thanks for having me.
Yeah, thank you. I appreciate you taking the time. I know you guys are busy over there. Hey, look, get us started. Just tell us, Centura Wealth Advisors, what do you guys do over there?
We do planning, largely income tax planning, wealth transfer planning, and asset management for ultra high net worth families all across the country.
And we talked a little bit yesterday about this whole sort of two-pronged approach, like the planning part and the asset management part. I view your guys' industry to a certain extent. The asset management part of it, I'm not in it, so I'm just a little bit speculating that it could be viewed a bit as a commodity, not unlike in our business, kind of just commercial debt brokerage. But then I think that other piece you guys are talking about, the tax planning, isn't something that is probably as broadly offered as what a financial planner under LPL or somebody like that might provide. I'm just curious how you guys think about that bifurcated approach.
Yeah, I think that asset management, look, if you go back, let's go when I first started, like in the 90s, access was, the internet was just starting. And so people really needed stockbrokers and whatnot for access. And then as there became more transparency and people could have access, then fees really came down. And as fees and trading really became really, really cheap, all the way down to robo-advisors for the commodity type services. I think for ultra high net worth families, though, there is so much more sophistication in asset management offerings, whether it be trading to manage capital gains exposures, all kinds of debt instruments, and how are you going to have your overall the debt side of your balance sheet? How do you manage that? So I think there's a fair bit to it for ultra high net worth families. I definitely agree it's a commodity for people that have $1 million to do that.
Yeah, cool. So what trends and sort of opportunities and challenges are you guys seeing right now? Like what's happening in your day-to-day? What's the market look like? And I don't mean that in the stock market, but as the market as wealth management, wealth advisor.
Yeah, I think there's some pretty good parallels to the real estate market. I think that there were some significant developments over the last 30 years in real estate, whereby you could really use depreciation or turn depreciation into expense to really manage real estate income, so you're not paying taxes on your real estate income. I think the same kinds of solutions are available now in public markets as well, and even tools that even have stronger ability to manage your tax exposure, whether that be on the capital gain side or on the ordinary income side. There are ways to harvest losses out of your stock and portfolios, get those on your tax returns to really mitigate all income taxes on somebody's balance sheet, whether it be income from a job, W-2 income, income coming from a business, income coming from your real estate, from your retirement accounts, or from selling appreciated assets, whether that be stocks, or real estate, or your business interest.
Hmm. Uh, take me through a for instance. It sounds like it's a really central part of what you guys are doing. Candidly, I didn't realize it was that central. So, I've got a company I'm going to sell, or I just sold an apartment building. I've got a 20% gain on the cost basis of the asset. Either of those. So I don't know, pick that or anything else, and just sort of talk to the opportunity that's out there. Most people look, it's not what you make, it's what you keep. I think this is where you guys play, but where are you seeing opportunities to level people up in the game of keeping more?
Yeah, let me start with have you heard of index replication?
No.
Okay. So in 2013, Robinhood drove as a custodian, drove all custodians to drive trading costs to zero. When that happened, that allowed, we've eliminated that friction from the equation. That allowed folks to create new products. And index replication says, depending on which white paper you read, you could add between 0.5% and 2% a year to your bottom line by, instead of owning the S&P 500 as a mutual fund. The challenge with that is fees and other people's taxes, because you buy into the mutual fund, you get potentially you own the mutual fund and there's built-in gains in there. So it only trades one time per day at the end of the day, not too efficient. Around 2000 or so, ETFs kind of took over to say, hey, I can buy an ETF for much lower cost. I don't have the tax issue because I don't have the built-in gains. Index replication entered in 2013, 2014 that said, I don't need to own 500 stocks in the S&P 500 in order to get the exposure of the S&P 500. I can own 50 stocks. And if my biotech stock goes down, if Merck goes down, I can sell Merck, harvest the loss, and turn around and buy Pfizer. Okay. By doing that, and it's logarithmic, you put these trading software on top of these holdings, and this is happening all day long, 300, all the days the market's open in a year. Depending on who you read, you can get the same performance, but you're harvesting losses, which can add between 0.5% and 2% a year.
That's interesting. So rather than having the single QSIP that's an ETF that might be 50 of the 500 S&Ps, I actually own 50 individual QSIPs in a proportion that would be similar to that ETF. And then when there's a downside variance, harvest the loss and move to something that's a close enough analog that I'm getting the same exposure.
Well said. It's exactly that.
Nice.
So if you don't have what we call tracking error, there's some other risks that need to be mitigated. We should get largely the exposure desired. So if it's S&P, we're going to get the S&P performance up or down. At the same time, I'm going to harvest some basis every year, and that those losses, it's going to lower my cost basis of my holding, but those losses will end up on my tax return. When those losses end up on your tax return, they go to you get to use all those losses against any gains. And then you get to write off $3,000. It'll appear on the front page of your 1040 of a negative 3,000. The rest of it sits on your Schedule D and waits for gains. So if I have 100,000 in losses and I have 20,000 in gains, it's going to wipe out the 20,000 in gains, and it's going to put a negative 3,000 on my tax return. So 100 minus the 20 in gains is 80, minus 3,000 is 77,000. That's what will sit on the tax return for the next year until I have gains.
Is this
Makes sense?
widely? Yeah, it actually does make sense. Is this widely practiced? Because I've heard about the tax loss harvesting in like well, now, right? It's worth saying it's December 19th. This is the time you might go, okay, hey, what can I sell? Harvest the losses. If you were to go buy the same stock, right? If you sold Ford, and this is how I understand it, because you made a loss, and you wanted to buy Ford again, I think you have to wait 30, 31 days to do it, in which case it could move. The way you're doing it sounds like it's more instantaneous, but I have never heard of this. Is this broadly practiced, or is this kind of the cutting edge of finding some efficiencies?
So this has become pretty popular since 2013, and most financial advisors that are dealing with ultra high net worth, I would say the lion's share of them know this strategy well. And lots of people have lots of solutions to replicate lots of different indices to do this. So this is pretty common. What you're talking about, harvesting, that's manual harvesting at year end, and everybody still does that to say, hey, what else is out there? But this is, how do we systematically set up solutions to do this on a day in, day out basis? And the other thing that we should just tease out is, you alluded to wash sales. You're right. If I sell the asset I in equities and I go to buy it back, I must wait 31 days. And so you're right. I need to wait 31 days. It could move, and I might not get the same performance. I likely don't get the same performance. So I it wouldn't work by buying the same asset. Um, that's not the case in crypto. You can do that. They don't have the wash rules, so you can do this stuff today until they change the rules in crypto, but you cannot do it in equities.
Hmm. Interesting. Um, are you guys making like I know that the answer in all of these questions is, well, correct me if I'm wrong, but I suspect the answer is it depends. Different clients, different risk profiles, different ages, different objectives, and I imagine you're setting up plans to uh, comport to their preferences in that regard. But putting that aside, are you guys allocating into crypto now?
We are not. We have been precluded from doing so because the SEC was totally against this for a lot of reasons. That might be changing. Gary Gensler has now left the SEC with Trump uh, being elected, and I think the worlds will be changing around that. But today we are not.
Okay. Just I'm going to go back to the top. Ultra high net worth. Um, I think I know the definition, but for benefit of listeners, there is an objective test there, right?
There is. How we define it when we think about people who need planning services. A lot of folks define planning as cash flow planning. Hey, we're going to manage all your cash flow to get you to see how, what's going on. Or there's goal based planning. Hey, we're going to plan for these different things in life that are significant to you and your family. And then there's asset location and asset allocation. And then they stress test it with Monte Carlo simulation. Let's now stress the variables and see, what does equity risk do to your plan? What does inflation do to your plan? What does, these main variables? And then say, look, what's the probability of success? And where should you be worried, and buttress your plan? And we think that helps some folks, and emotionally that helps some folks, but that largely does not help the people that we serve. The planning that we engage in is for folks that have income north of $2 million, and they typically. So if you have $2 million of income and you're here in California, you're paying 900 grand in state and federal income tax, and you have, depending on what their facts, assumptions, goals, and what they tell us, we largely probably can mitigate 50% or more of that tax, but they have to have a big enough balance sheet to have us help. And we find it, the minimum is $20 million. If they have 20 million, they'll put the three or four things in place necessary to mitigate the taxes. Um, Sometimes on a particular profile, we can take somebody less than that. But for the most part, that's what we were talking about from a planning standpoint. have to have 2 million of income and 20 million of net worth or more. And that's where it really makes sense for us to get involved from a planning perspective.
And the industry would say, I think it's 35 million is sort of technically the ultra high net worth. Is that right?
Yeah, I think it just depends. You have all kinds of different numbers floating all over, depending on, it depends on who defines it. But yeah, I've heard that. Heard sometimes it's 50 or 100 million. So it just
Okay.
depends on. It's all over the map. So
So
that's for high net worth for us. Ultra high net worth to do planning is 20 million and above, and then but we still take clients on for an investment management that have at least $2 million to give us to manage on their behalf.
a new version of 2 and 20. So if somebody's got right, if somebody's got
Yeah.
a version of sorry, they've got that $20 million balance sheet aside from the and this is all just like opportunities you guys are seeing in the marketplace. Aside from something like index replication, what kind of tools are you focused on putting in front of them? We're going deep into the guts of the beast here right away, but I think it's relevant and of interest to listeners, the kinds of strategies that exist to, if you're saying somebody with a $900,000 tax bill might be able to drop that to 500, where do we sign up? I mean, that's pretty compelling.
Yeah. So I think that the first thing that needs to be done after gathering these facts, assumptions, goals, we're going to, in that gathering the facts is these assumptions is about the income. And so it's really saying, okay, we're going in 2026. Let's look out over the next 5 years to say, what are the flavors of income? Now, largely our clients are business owners or C-level executives. So what's the flavor of income? Let's get all those flavors in there. How much of it is ordinary? How much of it comes from real estate? How much of it comes from business? How much of it comes from capital gains, interest, dividends? We need to know. And then we can just do an assessment to say, listen, if the tax laws don't change and you reside here and here's your income, make it up. Let's say, hey, I'm going to have 20 million of income over the next 5 years, and my tax is going to be not $8 million. Okay, that's baseline. We're going to now measure solutions against that to say, how can we affect that? And so I shared with you on the capital gain side, do you have enough assets on your balance sheet that we can go into what I talked to you about was index replication? That strategy has been expanded. So I just shared with you about, let's just say you had $1 and you bought these 50 stocks and you're doing index replication on $1. About 5 years ago, people said, well, gosh, if we could do it on $1, why don't we leverage that? Why don't we buy 30 cents long and go 30 cents short so that we don't get any more equity exposure? We can now accelerate the losses onto our tax return. Wow, that's pretty cool. If I get any equity exposure and if the borrowing costs between going long and going short kind of cancels each other out, that's a pretty neat solution. So then you as an individual taxpayer or customer to a custodian like Charles Schwab or Fidelity or other, will say, hey, you can borrow, Kevin, on your $1. We'll allow you to borrow 50 cents up to $1. But if somebody like us, who's a registered investment advisor, if we can extend credit to you with the custodian, we can take you from $2 up to $5. We can really lever up this situation. So if we believe in the strategy and we're seeing it working, like, gosh, I can do it myself at up to $2, but with a firm like Derek's, we could take it up to $5. I can really get losses on my tax return from a capital loss standpoint. Does that make sense?
Ish. So if to stay with let's go for we'll borrow 2 against the 1, right? So I've got the $1 that I would have been working with. We go through you guys. We borrow 2 more. One of them's, or maybe we just borrow 1, make it easier. We're going to take $1 long, $1 short. You're saying I'm multiplying
So
my
that's borrowing 2. That would be borrowing 2. So
Okay,
you got
cool.
$1 long. You buy an extra dollar to go long and an extra dollar to go short. So you got $3 of exposure. You borrowed 2. The goal is to suck the basis of all $3 onto the tax return. And that can take 5 to 10 years, depending on what the underlying dollar is and what that looks like. But it's a way to get a bunch of capital losses out of the equity market onto your tax return to mitigate other capital gains. What we're seeing, as we see since 2009, clients have massive run-ups in the value of their real estate, their equities, and their business interests. So they've got these massive gains. Now, I often ask clients, if you could take your wand and just change the allocation of, assuming you're not lockups and taxes and all, like, forget about all that. What would you do? And clients often tell me, hey, this is what I would do. And it's really smart stuff, like what they would do. But they're locked into positions due to taxes and lockups and ways that their mind is set. I can't. But if they aren't aware of the tools that could unlock some of the things that could say they can't, and they're putting off decisions because of taxes and other reasons that have locked them into thinking that they're thinking of how they're proceeding with their overall portfolio.
I mean, look, at the end of this, if you and I can't unpack it, we'll just say, reach out to Centura Wealth and people can talk to you guys directly. But go with me on this $1 that is principal, $1 borrowed long, $1 borrowed short. If the stock goes up 10%, my short position's losing, my long position's gaining. You're saying it's netting out only minus, the offset is the cost of the borrowing. How over time do I transfer those dollars onto my balance sheets as losses? Like where's the distortion that starts to go, okay, cool, that's a loss. I'll capture that.
Great question. So if in an up market, you're going to lose in the short position, correct?
Yes.
So we want to sell that short and get a different short.
Oh, okay.
In a down market,
we
want to sell the long. Okay. So now we got it coming and going. It's where we just tread water for a while. And in a sideways market, we may not be able to harvest much for a while. Does that make sense?
Yes.
But
that's just fascinating. Wow.
Yeah.
So you just swap it out and be like, hey, I was short here. I'm going to take that loss, replace it with another short. I'm still perfectly hedged. Doesn't matter what happens, but I just put a loss on doesn't matter even which way it goes. Could go up or it could go down.
Yeah.
Wow.
So
just enough time, you just sort of sit on that and.
Right. So that's a strategy on capital gains. We can do the same thing. We can produce ordinary losses as well in the futures market. So I won't bore you with how we do this stuff, but we can do the same thing and produce ordinary losses that will flow onto the tax return and be able to be utilized in the same way, whether that's for your business income or W-2 wages or retirement accounts you'll convert into Roth. So
I like it. This for all the jaded sort of skeptics out there about the equitability of the tax system. I mean, my brother is pretty high up military guy, and I had him out last year and we're talking about skiing and we were skiing and we were talking about taxes and wealthy people. And it's probably not perfectly true, but it's more true than not. Wealthy people don't pay taxes, right? So for all the people in that camp, listen to this and be like, so if I could just lever 2 or 3x and I could ride this thing long enough and start putting losses on my balance sheet, you guys are a good ally to have in the corner, that's for sure. Um,
So
what?
I think this.
Yeah, go ahead.
I was going to say. So when they say it's a commodity on asset management, I think
Yeah.
for for people that have balance sheets that are 2, 3, 4, 5 million, that's probably true. But as your wealth accumulates and you have more sophisticated problems, the solutions are far more sophisticated.
And you can't really probably reach the break point of this is a guess. Doing the strategy you just explained on $100,000, the administrative burden, the human capital, the management tasks, the sort of paperwork, like there's a lot of noise, I'm sure, that is downstream from doing these or making these decisions. It's not economical, right? Go from 100,000 to 10 million. Okay, this will actually be worthwhile. You can pay for the advisor, you can pay for the administrative burden, the tax processing, and it'll be a net gain.
Solutions start at $1 million in the account. Therefore, at least with us, maybe there's others that can go less, and then for leverage above and beyond, if where you want to get more than a dollar of leverage, then it's 3 million and up. So
Hmm.
yeah, we have kind of um, that's the minimum starting point.
What is it that brought you here? And I think you started Centura in 2018. I think that's what I read. But what gets you into this line of work where I mean, to say this is esoteric would probably be an understatement. What brings you here?
Yeah, I don't think people go to college and go, yeah, I'm going to learn how to do tax planning. That's what I'm going to be awesome at.
Totally.
Um, I grew up about an hour above Seattle. I spent a summer here in 1990. My older brother had a very large construction company. I spent a summer out in San Clemente Island. He was building Navy SEALs base out there, and I knew I wanted to get back to San Diego. Went back to school, finished my undergraduate degree in finance at the University of Washington, and then I worked for um, one of his competitors, and then I went to work for him. And he had a project down here. I'm like, send me down here to. It was on Camp Pendleton. I was here for a month. This was in '97, and he let this guy fire me. I'm like, are you kidding me? You're letting this guy fire me? I was so devastated. Just couldn't get out of bed for 3 days. Like, what kind of loyalty is that? Like, unbelievable. So I decided to go to work for Principal Financial Group. That was in '98, summer of '98. And then in February '99, my father at 66 had a massive stroke and died. And there was five of us. We had a blended family. I was just devastated. I was depressed for a year. I got my certified financial planning designation. And after a year coming out of the funk, I'm like, okay, this is what I'm going to do. So I'm going to help families get financially organized. My family was let down by all the professionals in their lives. And some of those issues still are present today. And I said, I think that people can do a better job in coordinating planning advice. So I was at a large firm. I started my first firm in 2001, and that firm went until 2014. And then we left that firm. They wanted to continue to focus on on a real estate offering, and so I decided to leave, and we started Centura Wealth Advisory in 2014. And here we are 11 years later, 62 of us, uh, 1.4 billion in assets. Two-thirds of our people are here in San Diego, one-third are all over the country.
Well done, man. That's a pretty quick trip past a billion. What I'm talking about your business. What channels have been effective for you guys in identifying opportunity to grow that base, or asked another way, um, what would you do more of if you could, and what's been a waste of time? Like, how do you guys go about getting to the right people and having that kind of growth?
Yeah, so we just got done completing voice of customer, voice of center of influence, and that was really helpful in giving us a lot of insights. Ultra net worth folks get referrals from centers of influence from other professionals and from other people that look like them. And so 90 to 95% of the people that we get are from other professionals that say you should go see these guys. They're fantastic at this planning game, and so do clients. What we have found, especially as we've done this voice of customer and voice of center of influence, is that we are really good with folks that this is their second or third group of professionals that they're working with. It isn't the first time that they've had advisors, though, and that was a big learning for us. There's folks that are brand new rich or haven't had advisors before, and they don't have that comparison between what we do versus what others have done, and those that have had lots of professionals in their lives before um, appreciate like the gratitude about what we do and how we do it for them seems to be different. So that's been a big learning for me and our team.
What is voice of customer, voice of center of influence? Is that a protocol? I've never heard of it.
We had an outside marketing group go interview, call it 20 clients across all kinds of different criteria. And so we're getting the voice of our customer on how they see us, how reflecting back what they see, what they value, what they don't like, what could have done better. And then same thing with our centers of influence. We have all kinds of CPAs and estate planning attorneys, all kinds of professionals that we refer to and they refer to us, that each has a specialty that or ultra high net worth families need.
So in hearing the voice of the customer or a center of influence, does that change your messaging to them? Does it change your posture? Does it change your offering? Does it change your strategy? Like, what do you do with that?
I think
Maybe
all of the above,
I was
right?
gonna say maybe all of the above.
Yeah.
Yeah.
So it just helps to better inform. I mean, I just gave you one example of how to better inform how we're doing what we're doing, who we should really take on, who we should potentially shy away from, who do we serve really well.
Hmm. That's interesting. So the thing to do more of is just probably get more clarity on how your value proposition shows up within the audience, and then just sort of go deeper there, right? For the people who don't understand what you're providing, don't waste your time. For those people that are echoing back to you what you consider your value proposition, spend more time there. Like, open that channel because they're actually hearing you.
100%.
Yeah.
When we take on somebody who's a planning client, if we can't see a minimum 5x return on the fees they're going to pay us and all the other professionals, then we don't want to take it on. So if it's going to cost them 100, make it easy, 200 grand in total fees to put all this stuff in place, they got to be saving $1 million or more at a minimum. We want to see them save 2, 3, 4 million. If they're saving that kind of money, they're telling other people. They're become raving fans pretty quickly. And so that's what we're looking for. And then who are those people that really appreciate it and that will connect us? Because that's the fastest way to grow your business, is having raving fans as clients and the people you serve.
Yeah. I mean, I've heard for years, a good marketing spend should be 5x, right? Put out $100,000, $500K of revenue shows up. I've never heard a wealth management shop kind of adhere to anything even remotely close to that. So that alone is, I think, a pretty strong differentiation for you guys. Earlier you kind of got into like the facts, assumptions, goals, like the flavor of the income, really doing a profile of the client, their investment objectives, and their I'll just say balance sheet, probably balance sheet and cash flow. So I get that. And that's as a backdrop to say, I know you're not a stockbroker. I know you're not a hedge fund trader, but I still think you guys must be exercising investment discretion, even within the framework, right? So, oh, let's just say there's three profiles. I know I'm oversimplifying. This is a type A investor. This is a type B investor. This is the type C. So for type A's, this is the formula we're executing, and we're going to do, let's just say, stocks, bonds, and alternatives. How do you guys think about mitigating the risks associated with the allocations for any of those? Let's just say it's 40% stocks. Like, how do you go, okay, these are the stocks? Like, and again, I know you're not a stockbroker, you're not a stock picker, you're not a hedge fund trader, you're not trying to necessarily find alpha, but still, like, you're picking something, right? You're not going out blindly. And I'm curious about that part of your business where it's like, okay, this is the strategy, and now let's go buy. How do you decide what to buy? Hopefully I'm making sense to you.
Yeah, so let's make it simple. Let's say that there's somebody that comes to us and they have $2 million to invest, and they don't really need sophisticated planning, right? They need this, potentially it's the below the line planning I described earlier, the cash flow, the goal-based planning, asset allocation, asset location, and some stress testing to understand the risks. Like, okay, we have $2 million to invest, and we're not over concentrated on our balance sheet. Here's the $2 million that you guys can invest on our behalf. It's probably $1 million in illiquid alternatives, largely in private real estate, like in private equity, and then $1 million in public markets. And so, what's the risk tolerance? What are we trying to accomplish? What's the duration? So we're building. There's 3 different allocations on the alternative side. Real estate's going to go into 4 different offerings over the next 2 years. The private credit's going to get allocated pretty quickly, but equity is going to take 2 years to get allocated. That's the private side. The public side, what is it we're trying to do, and how quickly can we get it put in place? And do we need to have a tax overlay? I mean, that's pretty simple, straightforward how we do that. Is that clear on the low end on what we do?
Absolutely. Yeah. And we'll get into the whole alts thing, the sort of private side of the market, but I'm trying to, so look, in my business, it's usually a single purpose entity, single asset with a sponsor. Could be a debt offering, it could be an equity offering, but the underwriting, it's fairly rigorous and there's a process to it, right? So I'm just trying to understand, to the extent that it can fit into a reasonably succinct conversation, because I can appreciate that it might not. Let's just take the private equity allocation for the 1 million that's going into alternatives, right? How do you guys go, okay, we're going to put of this guy's $1 million that's going into alternatives, let's put 330,000 into private equity and let's do this fund. Like, that part of it. How do you guys decide it's this product for this guy?
Question. So we we have an asset management department, and we determine what will be our core, what are our 3 or 4 core offerings, and then what are the private equity satellite offerings. And so private equity is who's calling down money today, who isn't, and where are we at, right? And so we could go deep into this, but different private equity offerings have different risk return profiles to them, that and focus on different things. So based on this person, what's available today, and how would we build that out based on that person? So we have core and satellite. So we underwrite it for the entire firm as to what does the firm need.
There you go.
And those are constantly changing.
There's a menu, and based on the menu that the firm has approved, you'll make an allocation based on the needs of the client.
Correct.
And is there a part of the team um, whose job it is to keep the menu fresh and make sure that those things are um, appropriate, on a risk adjusted basis, at least on a pro forma basis to meet the needs of the firm and the client? Like I'm trying to get into it's easy when you're like, hey, let's just buy IBM. We're good, right? But as you go into alts, it feels like, again, I know you're not a hedge fund guy, but which is to say, I'm not paying you exclusively for your investment discretion, but I think you still have some. And so I'm just trying to figure out when it gets to that point of creating the menu. Hey, these are our cores. These are the satellites. You can pick from these. Somebody's got to put them on the menu. I'm really curious about, from a wealth management perspective, how that, again,
So
I'm in the single asset play, so I live and breathe. Is this a good deal? I'm suspecting you guys have a vetting process to put it on the menu.
Yeah, I do. So good question. We have a chief investment officer who oversees the 6-person team, and that team is divided to public market folks and the private market folks, and that group surveys the 6 consulting teams through process to understand demand. Here's the demands of what is needed across all of the clients. And so, because we only have 6 folks, we've got a parking lot of who is going to get underwritten next in each of those 3 categories: private real estate, private equity, private credit. In the private equity standpoint, it's a function of demand and what's happening with the funds. The funds start closing, right? So we have some what's called a 40 Act, which are evergreen, which are stuff that we can place money in while we're waiting for new funds to become available. And so we have both call down funds, which are you make an allocation and call down the money over some period of time. And then we have stuff that we can allocate to right away. And how that's put together is demand from the teams. We do the underwriting, and anytime we have discretion, with the exception anytime there's lockup. Anytime there's a lockup, we go and get permission from the clients before we lock up money.
Okay, got it. Meaning a closed-end fund with fixed duration, they're going to be in it for 5 or 7 years.
Correct.
Okay,
They're
cool.
making each of those decisions. Yep.
That's super helpful. So CIO, three people underneath him looking at the publics, 3 people underneath him looking at the privates, 6 consulting teams externally that help you vet things coming in front of you to see if they're a match for the strategies and the things the firm is setting out to do.
6 consulting teams internally that manage clients. So each
I
of
got
those
you.
teams
I got you.
Yeah.
Those are the
Each
asset
of those-
management teams.
They're planning and asset. They're a combination of both planning and investment management. So
Got it.
they have between 3 to 6 people on each team.
Cool. That's helpful. So look, that's the segue. I knew we would get here, and we'll come back to some of the other stuff here. But in that framework, right? In my world, I'm seeing there's this, commercial real estate. I'm seeing the institutional LP equity, for the most part, they've vacated the marketplace. There's not a real aggressive bid for much. They're looking for distress. There's not a ton of distress. I would say at the institutional level, there's times for allocating and there's times for protecting. And it feels like they're in a time of protecting and or rebalancing. So there's just not a lot of the top of the capital stack to get deals going. And yet there's in the zeitgeist, there's a lot of interest in family office and RIAs. And I think it's largely led by Leon Black and other, sort of industry people saying, hey, it's no longer 60-40, it's whatever he is. I think he's 50-30-20, right? Stocks, bonds, and alts. And you see Apollo, you see Blue Owl, everybody's kind of going, hey, private capital, private credit, private equity. And they're targeting private wealth to sort of fill their huge machines, or that are these asset management machines and fee generation. So I've got developers who are like, hey, I'm going to target the RIA space. I'm going to target the family office space. That's where the cheese is. If I listen to you and kind of go, okay, hey, look, I'm dealing with multiple clients who have $20 million balance sheets or higher. I've made a full assessment of their needs. I have a CIO who's got 6 people underneath him. I'm kind of wanting to disrobe the developer who thinks he's going to call up Derek at Centura and say, hey, I've got a development deal in downtown San Diego. Why don't you guys put $10 million? It seems to me like you're the probability of that happening and the lure of all these middle market entrepreneurs saying, I'm going to go to the RIAs and family offices to get my equity allocation. It seems like it's a pipe dream. So it's kind of a monologue. I apologize for that. But like, I'm looking at this space and thinking it's a nothing. Everybody's like looking for this unicorn in an alternative equity allocator that is the family office or the RIA. And structurally, I just don't see how it will ever work.
Yeah, I mean, I can only speak for us, and potentially other RIAs, but I mean, our process is to underwrite the sponsor, right? So we want to understand their history and how they've done, what they put out prior to transactions, and is it what is it a buy and hold forever? Is it a buy and hold and operate and plan on disposing in 5 to 7 years, from 1031 to the next? Those are the sponsors that we're looking for. Underwrite the sponsor, underwrite all the transactions they've already done, what's on book, and then do they do enough transactions in the markets that we want to be in and the MSAs we want to be in the sector of real estate we want to be in. We're only underwriting in multifamily, a little bit in storage and medical office buildings. We're not in other sectors. And then, we only, we don't want to be adversely selected. We only want to take 30-40% of each transaction. We want, so how do we develop a relationship with folks that is going to meet the demand that we have on our side, that's going to fill our real estate bucket for the clients that we serve. That's, one-off transactions kills everybody. One-offs. We're trying to build a system that works for all. Will those developers be able to create a relationship with the family office that's going to meet their demand needs to build long-term relationships, to be a partner? Maybe that's a better avenue. I don't know.
Mm-hmm. But for you guys, what I just heard you say is like, we're not going to be more than 30%. I need to see your track record. I need to know what markets you're in. I need to know the volume of deals you're anticipating doing versus what you've done in the past. That seems to me like a group that's got a real track record and some tenure, not a onesie twosie team of, call it 2 to 6 entrepreneurs that have been syndicating here and there with mixed results, right? For them to be a reliable recipient of a firm like yours allocation, it seems like is a pretty high bar to clear. I don't want to put words in your mouth, but I think that's what I hear.
Yeah, I mean, we want to be a good partner. And so we're looking for people that we think we can be a good partner to, and they can conversely be a good partner to us as well. So we're looking for something specific and that's going to meet the needs of our demand and vice versa.
Mm-hmm. That whole private wealth trend, I may have it wrong, but I wonder what your thoughts are on it. I don't want to kind of recast that whole monologue again, but just this, it strikes me that the big shops are trying to aggregate private client or private wealth liquidity. There's like, $50 trillion of assets in the private side, but very little of that money has made it into the institutional asset management shops that are like the Apollos, the Blue Owls, the BlackRocks. What's your read on that whole sort of phenomenon that seems to be unfolding at the moment?
It is unfolding. I think that I think people in my asset investment management department could better comment because they're closer to it. They review it annually. We um, at times underwrite some of their offerings. Some of those names that you've said we have underwritten in the last 4 or 5 years and have not participated. So for a variety of reasons, whether it be fees or excess or whatever the reason is. So um, I'm close enough to really give you my insights.
Yeah.
I know that we underwrite and consider, and for whatever reason, it hasn't fit us.
Yeah. I'm sure fees as a part of it. Um, well, let's talk about your team. I think you just said you've gotten up to 60 people from the 2014 start, 1.4 billion under management. How do you find and retain the right talent for your team?
Yeah, I think it starts with your core values and what are the core values of the organization, and then really, I think this has been a super big learning for me over the years. It's been frustrating as well as this is where I've fallen down and not done a good job. I spent a fair bit of time figuring out how to do this better, better, and better. But it's making sure that first and foremost that we have 6 core values at our firm, and this is how we make all decisions based on these core values. And then it's really this GWC of each rule. Do they get it? Do they want it? And do they have the capacity to do this job? And even if they don't have 100% of the capacity, our framework it's an EOS framework,
Mhm.
entrepreneur's operating system. But it's in the next 6 months, we believe this person can develop the capacity to do this job? And so, um, you know, the our entire interviewing process, sometimes we've gotten feedback is way too cumbersome, way too difficult, too much homework, to gosh, we've gone too fast and not gotten the right person in the right spot. And you know, we own as much responsibility as the person that comes in at getting people in the right spot to be successful.
Uh, you guys run a full EOS kind of protocol over there?
We do. We started 18 months ago.
Oh, wow.
We previously had probably used a third of the tools. As you get deeper and deeper to the program, you realize, wow, we weren't using those tools very effectively. So it's a process. I think we're still not. I mean, we're using it day in and day out. I really like the overall system. I think it's provided us a lot of clarity and structure. And I think the team would echo my sentiments there.
Um, we're on the same system, and I probably couldn't in this scenario um, recite for you all of our core values. But do you have any that come to your mind that you think are especially uh, useful in decisions of like hiring and firing?
So
Any of your core values?
yeah, I just hit them quickly. It's accountability, excellence, passion, humility, transparency, and collaboration. And absolutely love the way we had 6 core values previously. And a year and a half ago, our facilitator said, look, we have the executive team in the room, put names on the board of the top performers of the company. We had 4 or 5 names. I said, okay, what are the adjectives that describe those names? Put those adjectives, lots of adjectives. He spent the time getting those adjectives around these 6 core principles here. We get done to say, these are the 6. We then say, okay, we're going to rank these 5 people that were on the board. All people in there are going to rank them. And you get one of 3 rankings. It's either A, that they get it at plus, that they do this 80% of the time regarding accountable. They're 80% of the time accountable, or they're a check, meaning 50, 80%, or they're minus below 50%. And we did all 6 core values in those 5 people. They all got pluses.
Mm.
Then the next step was, okay, take some people who have left the organization. Let's rank them. Several of them minuses. Then the final litmus test is we're going to rank you, the executive team, amongst each other. So is what you're putting out in the world actually what you guys live? It'd be awful if you guys go out there and put this out and you guys don't live it. And we got pretty much across the board pluses. There were a few checks in there. For the most part, we ranked each other. And so that's how we got to our 6 core values and replaced 3 values that we had previously. And I loved the exercise. I thought I'd repeat it here today. I thought that was fabulous work.
That's very cool. I think it's misunderstood or underutilized, right? Like I watched that. We were talking about the NFL earlier. I watch NFL teams and like they all have the talent, right? For the most part. Like, yes, there's some superstars that can do things others can't. But somehow there's a team that shows up under certain coaches, and those coaches can move around and they can still find the qualities that make something exceptional. And I think drilling down into core values like this and, doing your hiring and firing around that kind of North Star is really powerful. It's cool you guys got it going. What's that?
Yeah, 100%. And
Yeah.
I think that's a great way to look at it is those coaches have got those core values to build that team to get everybody to buy in. And they get it.
Your business is different than a lot of like traditional kind of real estate businesses where everybody has to respond to cycles. And so a lot of times, like the listeners for this show tend to stay lightweight and nimble. Not all of them. Some of them build big platforms, which seems like where you are. But how do you think about, as you grow your business, the decision to bring on overhead and get the economies of scale that may be associated with that versus keeping it as a variable expense that maybe you consult for and try to stay a little bit more nimble and light? I know it's a different business for you because you build AUM and you can start to count on those revenues on a recurring basis, but it's still something I'm sure you struggle with. How do you think about scale versus staying light?
Yeah, I think it's a great question. Our business, there's massive consolidation going on. I think about the business from first from the employee's standpoint, and then second from the client standpoint. And I think people would say, "So why do you think about it like that?" If the employees and the partners aren't extremely satisfied with their career track and what they're going, they're going to leave, and they're not going to be here to serve clients.
Yeah.
And then secondly, we need to do what's in the best interest of the clients to serve them well. And so I view it kind of like Goldilocks. The as the M&A continues to happen, the roll-ups continue to happen, and the fee compressions continue to happen at the custodians. The custodians are taking away more services, and you got to charge more to registered investment advisors if you don't grow. However, if you are too large, so being too small is a disadvantage. They're gonna continue to give you less and less services. You're not going to have access to the alternatives that you need. It's going to cost more. Conversely, if you get too big, you cannot allocate to the smallest, most nimble asset managers on the alternative side. And there's a lot of literature out there that says as you grow as an asset manager, you typically start diluting what you do really well, and the returns aren't as good. And so, for us, we believe that, we are not big enough yet. We could probably grow 5x, 10x, and still be where you want to be in this Goldilocks scenario. But we don't want to be too big as well that we cannot serve the people that we serve really, really well.
What's driving all the consolidation in your industry? Why is that happening?
Well, there was super cheap money for a long time, right? Number one. Number two, they realized how sticky these revenue sources were. And then number three, it was not institutional, right? You had a lot of, money allowed to own this RIA, and it was not professionalized, was not institutionalized, and they could buy it at a really great multiple. And so that's what they're doing. And they're rolling people up left and right. And I think people in my industry never thought they could get the kind of multiple they were going to get. And fantastic. And the people who were buying it, they have visions of selling it for a higher multiple to other people down the road. As you do that and you get really big, you have to manage the lowest common denominator because you're worried about somebody screwing up the margins. And I see the direction that we want to head in. We really want to be a partner-owned organization on a go-forward basis, and so we're hoping that we're bringing the next group of talent to be able to own and operate this thing on a go-forward basis to keep the culture the same and continue serving clients the way we have been serving clients.
The partner-owned thing, does that I don't want to get into specifics that are inappropriate for a broader audience, but does that draw alignment between the key contributors and sort of the company's profit and loss? Like you're kind of getting more like a law firm in org structure?
Pretty similar. So we've continued to develop equity ownership that aligns interests. And you want to get people working and thinking like owners, and hopefully build a strong enough team that you can pass off that ownership, and it's just a partner-led organization.
Is that part of what you guys might do for those call them
people we serve?
Big, small client business owners? The CEO entrepreneur, he's got a $10 million revenue business. He's got C-suite talent. He's trying to figure out how to. I guess my question is that kind of a strategy something that you explore with some of your business owner clients for continuation of the enterprise or alignment for a liquidity event?
We want to outsource that to others because it's hard. It's hard to show people 5-10x returns on that labor effort.
Yeah.
And so although it's valuable, it dilutes what we do really, really well. And so we want to bring in others to do that work, to say that is something you should do and put in place. And these are the people that you should consult with in doing that work.
Cool. I'm going to go back to where we started because I know I missed something that you and I talked on briefly before, which was, look, the audience here is for sure a lot of real estate operators and developers. We were speaking about cost segregation and depreciation as a way to accelerate your losses on, and I'm going to let you get technical again because I think that's the nuance of your space. And welcome to 2025. We don't get to do things with big shades of gray and hand waving, but getting into the details matters. You had mentioned, is it TRP or TPR as an alternative to cost seg and depreciation that maybe doesn't require depreciation recapture. I honestly have no knowledge of this until we spoke, but I'd love you to take a moment and explain that. Another one of the tools you guys have to mitigate the tax consequences for high net and ultra high nets. And I think it's super relevant to the developer, commercial property investor who might be listening.
Okay, great. I think it's helpful to add a little bit of context. So,
yes,
cost segregation occurred in 1997. Hospitals sued the IRS. They said there's no way this building is going to last 39 years on a straight line depreciation. And they won the case. They said, look, the lights are going to wear out in 7, the carpet's going to wear out in 5. And the judge said, we agree. However, in order for you, hospital, in order to take that position, you have to get an engineered study to break down the building into the component parts. Okay, so it wasn't the case. And so now since 97, went in effect in 98, I don't know what percentage of commercial buildings, I forget, 25 or 30% of all buildings have a cost seg in place. So you're just taking the component parts of the building and putting so much into 5, 7, and 15-year life assets rather than if it's multifamily, 27 and a half years. If it's other commercial, it's 39 years. And then you're hitting it with double declining balance and really accelerating the depreciation the first 5 years. And as you know, Trump restored the bonus depreciation when Biden had taken it down 20% a year, and it was 40% this year. Trump on July 4th restored it back to 100% as of January 19th this year. So that's great. However, when the other thing it does is it accelerates all that appreciation. You get to use that against the income of the property or other properties you have, whether you're passive or active. We won't get into that, but it allows you to not pay taxes on all of that real estate income. And then you get towards the end of that life, you're like, hey, let me sell this in 1031 to something bigger and better. And as long as I do a successful 1031 exchange, I have a carryover basis, and if I buy a bigger property, I get to do that again on the larger amount. So that works great as long as you don't have a failed 1031 where you could end up having to recognize all the depreciation that you take. January 1st, 2012, the IRS came out and said on prelim regs, and it's called tangible property regulations, that said, here's the prelim regs. Then they went final January 1st, 2014. And what this allows you to do is it really works really well for improvements. You can go in and take those improvements that are already on your depreciation schedules, and it's a way to accelerate all of those improvements and take a TPR deduction. So it's a way to accelerate deductions more quickly. And here's the big distinction. It's no longer depreciation. It's an expense. You don't amend prior returns. You get to take it this year. We learned about this 2 years ago. We've been allocating money in multifamily for the last probably about 15 years or so, maybe 13 years, something like that. We're like, come on, how do we not know about this?
Right.
Boy, like we've been doing this all this time. And the more we dig in, the more we realize, wow, big opportunity. So we have had some huge success stories here where we're going to some clients and the results are, hey, there's $3, $5, $10 million in deductions that we can take now. And if you have the income, like fantastic. If you don't have the income, you got to time it out to figure out how to do it, how best to capitalize on this opportunity. So we work with a group that's almost exclusively what they do. They've got an 8 or 9 person office back in Pittsburgh. Great group. So anyway, that's typical.
What falls into the bucket of improvements? Like that seems.
So, look, we've any kind of improvements that you have to capitalize and depreciate, right? So, think of anything that that you've improved on these properties, whether it be tenant improvements, whether it be, you're turning over all of these restaurants, you have all these improvements for getting those things situated for you. You got a franchise model. So there's anything that you are required to depreciate is an opportunity to go evaluate that and say, is there a better way?
But does, I'm familiar with the cost seg and all that. So we start with like foundations, framing, mechanical, electrical, plumbing, sheetrock, carpet, cabinets, fixtures, lighting. Okay, got a building. Are some of those considered improvements and could be expensed as opposed to depreciated?
You could, but maybe you already did a cost seg, right? So maybe you already consumed. Maybe it's not available because you bought the building for $1 the building's 20 cents allocated to land and 80 cents allocated to all the improvements, and maybe you did a cost seg. And so maybe there isn't a lot of life left there, but you've done improvements over the last 15 years, and maybe there's 10 million improvements and we're only 30% through the improvements. Maybe we want to pull that 7 million forward and use it all today. And it's an expense, not a depreciation recapture. And we get to use it all today.
Yeah. I mean, I love what you guys are doing. It's like you started with the idea of, back in the day, it was about access. You paid a broker to get access, and then internet came and everybody had access. And so fees got ground down, and sort of fast forward now, and it's like, okay, well, the advisory thing is one thing, but do you actually understand the more, so the broader view of the entire exercise that you're engaged in as an operator or business owner? Hey, look, if you did this TPR instead of depreciation, you would never have a depreciation recapture. I mean, that's just one example, but you guys are extending the value proposition from asset management into a much more sophisticated, like broader basket, which seems like a really compelling competitive wedge to differentiate you from everybody else. I mean, I'd just say hats off. It's very cool.
Yeah, thank you very much. It's a lot of hard work, but adds real value to the folks who we serve.
Yeah. Let's shift personal. Like, you have obviously done really well. What is it that you might have on your daily, weekly, monthly, I don't know, call it the Stephen Covey idea of sharpening the saw, routines or rituals, habits, practices? How do you do what you do as a person? Where's your, um, like, is there a routine that makes you, stronger on the day to day to sort of deal with 60 some people? I'm sure that's a layup, right? It's always easy. Everybody's always got your back.
Yeah, the hardest part of any job is the people, right?
Yeah.
But I think what you're speaking about is, hey, how do you stay sharp and sharpen the saw? Love
Yep.
Stephen Covey's 7 Habits of Highly Effective People. Um, so, look, I think first it's about staying informed. There's a couple different sources I read every single day that scour what's going on in the market. So that's my morning routine to read that stuff. There's 2 CIOs that I read every weekend that I like. I like their points of view. And I get to sit in 2 IC meetings, investment committee meetings, one from public markets once a month, once on our private markets. All those things really help me stay informed. I am in a study group that meets twice a year for 3 days, twice a year, that we share best practices and ideas. I'm on a board that I've been on for the last 3 years, an industry board that this year I got to serve as the chairman, and the CEO of that group. I get to meet with him frequently. It really helps. Uh, it's a great sounding board for me. I mean, I'm able to contribute, but I also get lots from being on that board and sharing and hearing what's going on. So, those are the ways. I'm not studying for a new designation or
Securities license.
Yeah, graduate degree. But I am so curious, love learning, love understanding what else is happening in our industry. And those are the ways that I stay informed and stay at the top of the game.
I think you said CNOs, 2 CNOs that you read every weekend. What's a CNO?
Oh, I'm sorry, CIO, Chief Investment
Okay,
Officer.
Chief Investment Officer. Yeah.
Yeah.
And they
Yeah.
put out like weekly pieces on kind of opinion pieces. And
Yeah. Eric Peters is the CIO of One River Asset Management, and he writes a piece. Sometimes he gets lazy and publishes an old piece, but I love his goes through all markets, but then goes through his anecdotes of learning, and he interviews the titans of the industry. I find it very, very insightful, very helpful. And then the other CIOs, kind of, there's a mixed bag of people that I read. So yeah, it's just, how to get information quickly, um, to understand what other, I'm not going to spend that's the amount of time allocation I can afford to spend to stay current.
Yep. Um, Jim Collins, Good to Great, right? He talks about one of the qualities of exceptional leaders is their ability to zoom in and zoom out, right? Fly at 50,000 feet, see the landscape, and then get right down into the minutia of, perhaps the circuitry on some sort of silicon wafer and actually, you know, be able to travel that whole distance with some fluidity. How do you find your day to day, in the weeds, up high? How do you balance that kind of working on the business, working in the business? How do you think about that dynamic with your role or your role, as should say, as it has evolved into what it is now?
Yeah, great question. I think I continue to suffer there in that I spend too much time working in the business and not enough time working on the business, which is probably like a lot of entrepreneurs. Um, but I'm continuing to work my way out of the jobs that I currently hold, and I, you know, uh, my legacy in this work, like, what, Derek, why are you so motivated to continue to do this work? I'm highly motivated to help the people that I work with get to where they want to go. That provides me both of my parents were teachers. I really want to see those people succeed and accomplish their professional and personal goals. And that is highly motivational to me. And so continuing to get out of the day to day and into the things that's going to allow me to do that and do that well is what really keeps me highly motivated to go.
Uh, Two questions from that. When you say helping the people get where they want to go, is that the people in the organization or the clients outside of the organization?
Yeah, it's the former. It's the folks in the organization that are dedicated to serving the clients that we serve.
Cool. And what's been effective for you to learn? Let me say it this way. How have you learned to get out of the business? Like, what sorts of things have come along where you're like, oh, wow, I don't need to do that anymore? I mean, I get it. Like, I think it's the entrepreneur's affliction, which is you started a company, which meant you did everything. And now you've got 60 people. And it's kind of like, okay, you're not, it's 120 hands. You're obviously not going to touch everything. How have you learned to like let go and kind of the
It's
opportunities that have taught you those lessons? If you can think of any of them, I think they're meaningful.
Yeah, it's I think getting really clear. I think getting EOS for us was a big win. But getting really clear on your accountability chart.
Mm,
And, um, something that I've fallen into over and over and over again is when you're putting together an org chart, you think about the people you have and you're putting them in the org chart rather than don't think about any of the people you have. Build an accountability chart that your executive team believes is the way it should work. And then we'll go back and say, hey, do we have the right GWC, get it wanted capacity for the people in each of the spots? And so, you know, building an A plus team is been I mean, if you really want to let go of these things, you got to build an A plus team so that you have trust and confidence that you can let go of the vine.
mhm. So you alluded to it a little bit, but give me the 10-year view. Where's Centura 10 years out? And if that's too far, go with 5. But whatever horizon you can envision.
So 6 years ago, we had a 5 year plan. We just completed that 5 year plan, and
Nice.
we accomplished about half of the things in that 5 year plan. Still, lots of fantastic success, We put together a new 5-year plan a year ago. We're 1 year into that 5-year plan. The goal is to 4x the firm over that 5-year period. We're well on our way to doing that. And the staff is going to double. We're 55 last year. We're at 62 this year. We think we'll be at 120 at the end of the 5-year period. So we don't want to be the biggest. We just want to do the things that we do extremely well and really cater to the people that work there, that they really are gonna. There's growth opportunities for them and what they want, where they want to go, and that we serve the clients that we serve really, really well. So that's the plan.
That's cool. I'm just curious because you mentioned a while back that you have a bunch of people in San Diego and some remote. What's the thought in the geographic location of the staff as you 2x from here? Are you guys work from home? Are you work at the office? Are you a hybrid? Are you doing a lot of remote people who I'm making up, somebody's in Raleigh, where are people and how do you think about the office as you go through this 2x scaling?
So some of the folks we need to have here in San Diego. And so it's a reload package to get them here. But most of, we're going to hire the best person for the job. And unless we think they really need to be here in San Diego, they can be anywhere in the country. People who are local, we have a 4-day-a-week policy that 4 days a week, you got to be in the office.
Emerging entrepreneurs, right? You've been through it. It's you started one, I think you said in 2001, left that in 2014, started Centura. What's your advice for the entrepreneur who might be on top of it, feeling like they've just had a huge win, or might have just got their butts handed to them? Just some kind of reflecting back on where you started, where you've gotten to. Any quote unquote words of wisdom for the guys who are behind you?
Yeah, I think remain humble, get good mentors, and get a community. Find your tribe. Who's going to help you make decisions? Are you in a CEO group? I have a CEO group that is like my mini board of directors. Are you an EO? Are you find your tribe, find your mentors, remain humble.
Cool, man. I'm going to give you the mic here at the end. I appreciate you going, really technical. I don't know if that's where either of us anticipated this conversation going, but my view of any space kind of like yours, professional services, is that glossing over the nuance and the attribution for things that are as sophisticated as what you do does you a disservice, as opposed to like, hey, let's get into it. And obviously we're just scratching the surface, but I appreciate you being willing to sort of, if you will, nerd out on that stuff. I think it shows, domain expertise and that you guys really understand the construct, and you have extended that value proposition from just asset management into a full sort of strategic partnership. Very cool. But the mic is yours to kind of wrap it up however you like. And I will say thank you for taking the time, and listeners, go on and follow us and give us a review and do all that stuff. It helps the algorithmic world that we're all living in.
So Kevin, I just want to thank you so much for the opportunity to do this show with you today. I really enjoyed it, and I hope that provided value to those listening. So thank you.
Yeah. Thanks, Derek.